This session is going to be recorded today. So if you're not feeling comfortable about being recorded, you can certainly disconnect and know that this recording will be sent out to you right after this is complete. So otherwise, if you stay on, you're just consenting to be recorded along with any video or audio. So that's my disclosure. Today we're going to be talking about 1031 parties and properties. So we're going to dig a little bit deeper into some specifics of 1031 exchange. If anybody's been on one of our webinars before, we typically do different topics on a monthly basis. A lot of times we talk about basics because that's what people want to know. They want to know the basics of 1031. So we're going to start with the basics. We're going to spend 5 minutes on it. So it's not going to be the focus today. It's really going to be just really the side, a small part of it. So if you have more questions about that, feel free to stop me. I'm going to be monitoring the chat. I'm going to be monitoring the questions and answers. So if you don't feel comfortable unmuting yourself, you just type something in the chat or type something. It's easier chat than questions and answers, but just type something in the chat and I will get to those. But again, unmute yourself, raise your hand, let me know if you have any questions and stop me along the way. I typically talk for about a half hour, 40 minutes, and we can have a discussion as we go. So let's talk. Again, we're going to spend 5 minutes just going through the basics. Why 1031 exchange is so important and it's so beneficial. And it's so important because you are deferring a lot of taxes. If you had to sell a property without doing a 1031 exchange, these are all the taxes that you're going to be faced with. Now, I'm using Massachusetts as an example because I am in Massachusetts. But if you're not in Massachusetts, there are other state taxes. There are only a few states that don't have those state taxes, but I'm going to use Massachusetts as an example. Most people fall into this federal capital gains. Most people fall into the 20% range. So federal capital gains taxes are 20%. And then there's this NIIT tax, which is 3.8%. So it's called the net investment income tax. It's like an Obamacare or Medicare surcharge. It happens when you sell or you have a capital gain. With Massachusetts, there's a 5% state tax. And then last year, we implemented a 4% millionaires tax, which unfortunately hits most of my clients that aren't millionaires. So any dollar that you earn over $1 million is taxed at for an additional 4%. So as you can see, taxes start to add up. Kind of the biggest hit that most people take is the federal 25% recapture of depreciation. So the IRS allows you to depreciate properties over the course of, if it's a commercial building, over the course of 39 years. If it's a residential building, it's 27 and a half years. So they allow you to take this nice depreciation every year, but they recapture it at 25% when you sell the property. So as you can see, taxes add up. It's typically around 30 to 35% in tax that you would pay if you did not do a 1031 exchange. With the 1031 exchange, you're deferring those taxes and kicking the can down the road. So you're essentially bringing your basis over to your new property. This is just an example of a forward exchange. It's pretty straightforward. We act as qualified intermediaries. That's what Northern 1031 does. And the two big things that we do is that, one, we handle all of the paperwork. We make sure that you have your exchange is documented properly, that you have all of the exchange agreements in place and it shows all of your dates. We have everything timestamped using our DocuSign. So it starts when the taxpayer sells their relinquished property. They deed that property directly to their buyer. So at the closing, nothing really changes. They go to the closing, they sit at the table, they sign their deed over, the buyer takes title to that property that day. The only difference is the buyer is now paying the qualified intermediary. So the funds come directly to us. We hold those because this taxpayer can't have constructive receipt. So we hold those in a segregated subaccount. They're in your name, they're in your tax ID number, but we hold those for you. The clock starts ticking. You have 180 days total to purchase a new replacement property. So that's really the life of the exchange, 180 days. Those are calendar days. So make sure that you know, if your closing falls on Christmas Day or it falls on New Year's Day, you know you have to close the day before that, or prior the business day prior to that. So that's something that's really important. The hardest part of the whole exchange is right here. It's the 45-day identification period. So clients only have 45 days from the time that they sell their relinquished property to the time that they have to identify properties that they want to purchase. Again, hardest part, especially in this market, properties are a little bit hard to come by. So those do need to be identified, and we're going to get into the rules just really quick. But once it's identified, you have another 135 days to close. And people ask all the time, well, what happens if the seller backs out? Or what happens if the inspection doesn't come through, or the appraisal doesn't come through and I'm after my 45th day? Unfortunately, you're out of luck. If you've only identified one property, you are out of luck and you can't move forward with the exchange. So that's, your funds go back to you, but you can't exchange anymore. So it's important to really understand your identification and the properties that you have listed when you get to your 45th day. Once you've identified a property and you get into contract, you're going to go to the closing table, same as you normally would. Qualified intermediary is going to use those funds. They're going to pay the seller for the property. The seller is going to directly deed the property back to the taxpayer, and that completes the exchange. That's it. Pretty easy, straightforward. And that's a forward exchange. So I'm giving you really the most basic scenario. If anybody has any questions, just stop me along the way. Like I said, I'm just kind of breezing through the real basics right now. As we discussed, we have the 45-day exchange period, and that is baked into this 180 days. So really it's 180 days total. First 45 days is the ID period. And there are 3 specific rules that you have to use, that you have to choose from to identify. So the first rule is kind of the most common rule, and that's the rule of 3. That says that a taxpayer can identify 3 properties, and it doesn't matter what the value is. They can buy 1, they can buy 2, or they can buy all 3 of the properties. Most people that are selling 1 and buying 1 use the rule of 3, and they put a property on for their dream property, and then typically 2 backups. The 200% rule says that you can identify an unlimited number of properties. So it doesn't matter how many properties you have, but they cannot exceed 200% of the value of the property that you sold. This is used when people are diversifying. They want to buy 10 properties. So they're selling $1 million property. They can identify 10 $200,000 properties and buy all of them. So it's limited to the aggregate value of the properties you can purchase, but not the aggregate amount. In the 95% rule, this is used in very specific examples, mostly for DSTs, and we're going to get into that today. But the 95% rule essentially says that you can identify an unlimited number of properties for an unlimited value. But once you identify those, you have to buy 95% of the properties that you've identified. So it's very prohibitive in that respect, because you have to be very certain that you're going to purchase all of these properties. So the different types of exchanges there are, that graph that I just showed you was essentially a forward exchange. So that means you're selling your relinquished first and you're purchasing your replacement. That's really the most basic. We have so that's what this delayed exchange with a qualified intermediary is. You can do multiple sales and multiple acquisitions. So you can certainly sell multiple properties and consolidate those down into one. Or you can sell one property and acquire multiple properties and really diversify your portfolio. So you can slice it and dice it any way you want. So if you sell one, you don't have to just buy one. You can buy as many as you'd like. There's the reverse exchange, and the reverse exchange is really popular now. I feel like everybody that I talk to wants to get into a reverse at this point in time. The reverse exchange allows you to to purchase a replacement property before having sold your relinquished property. So you can sell first, you can buy first. The reverse is buying first and then selling after. Same timeframes. You still have 180 days from the time that you take title to the replacement property. And then you have 180 days to sell. So we're going to do a webinar specifically on reverse improvement and improvement exchanges in the coming months. So be on the lookout. We're not going to get into too much detail on those two things today, on those two exchanges today. The improvement exchange, that allows you to sell an asset. Let's say it's $1 million, buy an asset that is maybe $800,000 that needs $200,000 worth of improvements. So the improvement exchange allows you to use your exchange proceeds to purchase and improve a property. Great option. Unfortunately, there's some time limits there, but same 180 days. And personal properties are now excluded, and we don't have to get into that. So we're talking about parties now. So this is really the meat of our discussion today. So we're going to be talking about the IRS requires that the same taxpayer in the same title, whoever owns the property, the relinquished property, needs to take title to the replacement property. So it needs to be the same taxpayer in the same title. So continuity of title is an important component of any 1031 exchange. In order to qualify for a tax deferral under 1031 exchange, the same taxpayer who owns the relinquished property must purchase the replacement property. So finding out who is the taxpayer, you obviously can see it on your tax returns. And believe it or not, people often have questions about whether or not their entity files a tax return, whether or not who the title holder is. So it is important when considering selling a property to go on to the Registry of Deeds or the tax assessor's office and find out who that title is under. So that is really important. Sometimes people create LLCs or create S Corps or create trusts and never actually file the title or transfer the title into that name. So there's a lot of discrepancies. It's important to have that understanding when you're going into an exchange. Understanding disregarded entities. So a disregarded entity is one that's ignored for federal tax purposes. It's treated as the individual or the single member that and it's tax reported for through that individual on personal tax returns. So I'm going to give you examples of those revocable living trusts. The single member LLC, that's a really popular one. So a single member LLC, the investor wants the liability protection of owning a property. So from a liability perspective, the LLC gives them that protection. But from a tax perspective, it's disregarded. The LLC is the same in the eyes of the tax holder as the individual. So the LLC doesn't even file a tax return. And then DST is a Delaware statutory trust. That's a disregarded entity as well. So we're going to dig deeper into that as we move forward. The nice part about the disregarded entities, if you have an LLC and you want the liability protection, the nice part about the disregarded entity is that you can take title to a replacement property in another disregarded entity. So let's say, for example, you hold your Main Street property in One Main Street LLC. And you are now do a 1031 exchange and you're going to buy two properties. You can create, and you don't want those properties under the same LLC. You can take One Main Street LLC as a disregarded entity and take title to one property, and then you can create, Michelle Fitzpatrick LLC and create another disregarded entity. So the disregarded entities give you a little bit of flexibility, or I can just take title to it in my individual name and not have I don't want to pay the LLC filing every year, or the $450 fee, whatever it is. You can take title to the property in your name as well. And that goes with the living trusts as well. So it gives you a lot of flexibility, and it gives you the protection that you want. As we discussed, limited liability is a really common way to hold property, more common than really any other thing that we see, especially for those investment properties. In the single member LLC, we have to talk about the difference between the single member and the multi-member LLC, because they are very different when you do a 1031 exchange. A single member LLC, like I said, and we discussed in the last slide, single member LLC is an individual. So a lot of flexibility there. Whereas the LLC with multiple members, now, once there are more than one member in an LLC, the LLC becomes the taxpayer. The LLC has its own tax ID number, it files its own returns, and then it issues K1s to all of the members. So now, if we're looking at doing an exchange with a multi-member LLC, that LLC has to be the owner, the title holder, and the taxpayer on the new property with all the same members. So that's where it gets a little bit difficult if you are a multi-member LLC and own a property. Any questions about that? Okay, so those are really the most common ways. I'm sure people have heard of tenants in common. This is what we love. We love when people, from an exchange standpoint only, this is not from I'm not an attorney, I'm not a CPA, and I'm not a bank lender. I'm talking strictly from an exchange standpoint. Tenants in common are the easiest way to hold property and exchange property. And I'll get into the reasons why. But when you hold property, and there are reasons why people don't do tenants in common, you don't get the liability protection. It's harder to maybe get a commercial loan when you're trying to lend to 5 different tenants in common. It's easier if you're just lending to one entity. So liability protection, lending, why else would you want an LLC? I think those are kind of the big reasons. And that's why sometimes people get out of the tenants in common and go to LLC. But tenants in common, each owner owns a fractional interest in the whole asset. So you have one property, everybody owns, 4 people own 25%. And what's nice is upon the death of one of the individuals or one of the tenants in common, it passes on to their heirs. So their heirs become that tenant in common with the other partners. And so from estate planning, that's kind of an easier, better way to transfer their interest. And why we like tenants in common is because, from an exchange standpoint, is because when you go to sell, all the parties can go their separate ways. So if I owned a property with, 2 partners and I wanted to exchange and the other 2 partners wanted to cash out, from a tenant in common structure, I can go and exchange my 33 1/3%, and my other 2 partners can take their cash, pay their taxes, and go. Really simple. It's so easy to get out of properties and exchange out of properties with tenants in common. What we always recommend with tenants in common is that you have an agreement that states exactly who the parties are and exactly what their interest is in that property. So that's really important. Does anybody have questions about that tenants in common? Okay. So the same taxpayer rule applies with spouses as well. So married couples kind of face challenges when it comes to that same taxpayer rule in non-communal property states where each spouse is considered separate. So if only one spouse is on the title to a relinquished property, then that spouse is the only one that can be on the title to the replacement property, which we come across a lot. A lot of people will say, you know, I bought a property before I got married, and now I've held on to this property and I've been married for 20 years and selling it. Can my spouse go on the replacement property? And the answer is yes and no. So let me see if I'm going to give you examples. So if a husband bought an investment property prior to marriage, he's the only person on the title. He's selling the property for $1 million and exchanging into a new property for $1 million. Can the spouse be added? Again, the answer is yes and no, but really no, because now the spouse needs to satisfy the husband, in this case, needs to satisfy his $1 million exchange. He needs to buy in his name equal or greater in value of that $1 million. So if he buys $1 million property and he puts his wife on it, and now they're 50-50 tenants in common, he bought down in value and he's going to have a tax. He bought $500,000 because his wife bought $500,000. So he's going to have a tax. So yes, she can be added, but from an exchange standpoint, it's not smart because now he's going to be taxed. Let's move to example 2. The husband bought an investment property prior to the marriage. He's the only person on the title. He's selling for $1 million and he's exchanging into a $2 million property. Can the spouse be added? Yes. In this case, the spouse can easily be added. The spouse will now be a 50-50 owner. They're buying the husband has satisfied his $1 million exchange by buying, even if he buys half, he's buying $1 million worth of property. So this scenario comes up a lot. And we can change ownerships. I have somebody that's, I think, selling for 400 and buying for 450. They're going to put the spouse on as a tenant in common with only like a 15% ownership or a 10% ownership or whatever the number is. So it's not 50-50, but they're drawing up a spousal tenant agreement. So that can happen. So we're going to go through the same scenario and the same exercise, but we're going to talk about LLCs. So as we discussed, when we have a multi-member LLC versus a tenant in common ownership and how this looks. So there are members in, so we're going to call this NBTC LLC owns this Main Street property. Looks beautiful, right on the water. Looks like it's in Miami. I'm liking it. So NBTC LLC owns the property, and Peter Pine, Paul Parker, and Mary Masters, they all are 33% owners in the LLC. So they are members and managers in this LLC. Peter wants to exchange to Florida, Paul wants to exchange to New Hampshire, and Mary wants to just take her cash and go out and buy a boat. Can this happen? And in this scenario, again, the answer is yes and no, but for this purposes, really no. This is not a good, easy exchange. Breaking up this partnership is very difficult. It's the LLC has to go on to buy Florida and buy New Hampshire, and there'll be a taxable obligation. So it's the whole LLC that owns the property. This scenario, the best way to do it, we have some really complicated exchange solutions with we're a nationwide renowned advisor that we use, a 1031 tax attorney, and he can structure it in a way. It's expensive, but it's possible. But it's not a straightforward exchange. It's multi-step exchanges, and Peter, Paul, and Mary all have to be in agreement and know that they're going to stick together for another year after they exchange in order to complete this. So this is complicated, and I want to say, no, it's not a great solution. Now, same scenario, however, 123 Main Street, this beautiful property on the beach, is owned as a tenant in common. And Peter, Paul, and Mary don't have an LLC, but they are 33% TIC owners in the property. So Peter wants to exchange in Florida, Paul's going to New Hampshire, and Mary wants to take cash and buy a boat. Can they do this? Absolutely. Super easy. They're going to sell for $900,000. They're all taking their $300,000. It's going to be listed on the settlement statement that Peter's exchanging, Paul's exchanging, Mary's cashing out. They're going to file their taxes with their amounts, with their $300,000, and they're going to be able to split and go their separate ways. Very easy. This is how we like it from an exchange standpoint. Any questions? I know I kind of blew through that a little bit, and we're going to be moving on to the properties in some replacement property options. So I wanted to give you an idea of the different types of parties that are involved in any exchange and how ownership should be structured. So we'll move on to the properties that are involved in 1031 exchanges. So you often hear 1031 exchange referred to as a like-kind exchange. In like-kind, there's a myth about like-kind. People tell us all the time or ask us all the time, well, if I sell a two-family, do I have to buy a two-family? Or if I sell a residential property, do I have to buy a residential property, or can they be mixed? Like-kind is very broad, and it really just means investment property for investment property. Rental property, it doesn't matter what the grade or the type of property is. So you can exchange a single family for a commercial building. You can exchange a commercial building for agricultural land or farmland. You can, really, you can slice it and dice it. A single family can be exchanged for a motel, vacant land for an office building. You can exchange a tenant in common interest share into a whole asset. So in the example that we used with Main Street, if you walked away with $300,000 as an interest share, all you have to do is reinvest $300,000. You can buy your own property, or you can buy an interest in another property. You take your $300,000 and you go find another partner and buy a $600,000 property. You can do that as well. So like-kind is very broad, and it just means investment property for investment property. The exceptions to these properties or to the 1031 exchange rules are personal residences. So your primary residence gets a tax exemption anyway. There's under the 121 IRS code, you get $250,000 tax exemption, not a deferral, an exemption for your primary residence, and $500 if you're married. So that you can take every 2 years. So your personal residences, your primary homes do not qualify. Now, vacation or second homes that are used primarily or exclusively for personal use. So if you have a second home that you do not rent and that you use more than 2 weeks a year, that does not get included. That's not able to be exchanged. However, vacation rentals can be exchanged. So we're not going to get into the details about that today, but if you have a VRBO that you restrict your usage to and that you don't use on for personal use, that can be exchanged. So there's a difference between that second home and that vacation rental. There's a little bit of a difference there. Any of the developers that flip houses, and that's their stock and trade. That's what they do on a regular basis. They buy a house, they sell it, and they flip it. They flip it and sell it. Those are not qualified because those aren't held for long term. They're specifically held for short-term gain, and they're excluded from 1031 exchange. Now, if an investor finds a house, they buy it, they had every intention of renting it, and their neighbor comes and knocks on their door after a year and says, you did such a beautiful job on this property, I'll give you 50% more than what you bought it for, whatever it is, and they take it and they only held it for a year, that's fine. That's not their stock and trade. That wasn't their intention. Their intention was to truly hold that property and rent it, but it's the flippers that don't qualify. Stocks, bonds, or notes, those are not exchangeable anymore. Those would be considered personal property. Any mortgage interests, those aren't exchangeable. Interest in partnerships, like I said, if you hold an LLC or a partnership, you can't just exchange your portion. And certificates of trust or beneficial interest, those are all exceptions. Oh, I did throw a vacation rental safe harbor in here, and I didn't realize that I was going to, I did that. So, like I said, second homes have zero tax benefits. So holding a second home, you can't depreciate it. You can't write off in any sort of expenses on it, and you can't exchange it. So if you go to sell your second home that you use exclusively for personal use, you're going to get taxed on it. However, vacation rentals are super, super big right now. We have so many people that are selling, a rental that they've owned, a two-family that they've had tenants in for years and years, and they're like, I'm going to think about retirement. We're 5-10 years away from retirement. I want to sell my two-family home that I've owned for 30 years, and I'm going to buy a house down in Florida and hopefully eventually retire in it. They can do that, especially with a little bit of preparation. So the IRS put in a safe harbor, which allows them to distinguish the difference between what a vacation rental is and what a second home is. And it simply says this: if you follow these rules, we're going to allow the exchange. We're not going to question it. So the relinquished property and the replacement property are owned by the taxpayer for at least 24 months. So the relinquished property that you're selling is owned for 24 months, and then you have to buy this replacement property and keep it for at least 24 months. Within the 2 of the 12-month periods, within each of those periods, you need to rent the property for a minimum of 2 weeks per year at fair market value. And you have to restrict your usage to the property, your personal usage, to 14 days a year or 10% of the time that's rented. Now, you can rent the property to a family member, but if it's rented to a family member, note that it has to be rented and they have to show it as their primary residence. So it's just eliminating somebody buying a property and saying, oh yeah, I just rented it to my daughter, and putting it on their tax returns and getting 2 weeks and satisfying their 2 weeks a year by renting it to their daughter. So, because it's not really considered, that's not a rental, that's really personal use still. So fair market value, 14 days rented to a non-related party. And then restrict your usage to 14 days or 10% of the time that's rented. And then after that 2 years, you can do whatever you want with it. So a lot of people turn it into their second home, or turn it into their retirement home, or keep it as a rental, like a full-time rental or a vacation rental, however they want. You can do anything you want with it after you've satisfied that exchange. Gives you a lot of flexibility. It's really good for estate planning, and it's really good for retirement planning. So people use this for their retirement plans a lot. Matt, to answer your question, is there a minimum hold period, or is the intent that matters? When it comes to the vacation rental, the safe harbor does state those minimum hold periods. So yes, 24 months is the hold period to qualify for the safe harbor. However, that does not, the intention, there's no other area in the code that says how long you have to hold a property for. So if I bought a property tomorrow and I only held it for a year and I decided to sell it, I can do that. That's not a problem, because my intention was I was going to hold it for long-term gain. Somebody knocked on my door and offered me some money. So the IRS looks at intention for all the other hold periods, except for this one. They stated it in this one. So I hope that answers your question. Delaware statutory trusts. Has anybody heard of Delaware statutory trusts? Good. There's a couple. We are in an incredibly tight market right now. We are in a time where there's not a whole lot of inventory on the market, and people are nervous. People are nervous about putting their properties up for sale because they're scared that if they're going to get an offer immediately. That's just the way the market is right now. And they're afraid that that 45-day window is going to come really quickly, and they're not going to have a replacement property lined up, and they are not going to be able to complete their exchange, and they're going to have to pay their taxes. This is the fear of everybody that we talk to. So Delaware statutory trusts are a great option for people that call us up and say, listen, I don't want to pay taxes. I don't care what I do. I'm not paying the taxes. I want to get out of this property. Delaware statutory trusts are available. So what they are, the IRS recognizes Delaware statutory trusts as replacement property for 1031 exchange. So the IRS says these qualify to purchase. I kind of have the description here, and I'm not going to read it all. I'm going to just kind of tell you what it is. You're buying a interest share in a larger property, in a Class A property, or in a different asset class of properties that you wouldn't normally be able to buy. So you would be buying an interest share in something like an apartment complex, or a medical office building, an Amazon distribution center, a nursing home. There's all sorts of types of properties, and they're always available, and you can choose which ones you think are most interesting, or that are the best fit for you. So here are the kind of pros of the Delaware Statutory Trust. There will be a whole bunch of different investors that will invest in this one property with you. I think they can have a maximum of 1,999. There's a minimum investment amount. So the investment amount ranges anywhere from $50,000 to $100,000 buy-in. So, you know, if you are an investor and you don't want to invest the full $100,000 or excuse me, $1 million into one property, this is a smaller buy-in. You can buy into property for $50,000 or $100,000. It really is super simple and super efficient. We have a lot of people that will close on their relinquished property on a Monday, and by Friday, they're already into a DST. The buy-in's very easy. There's no big, long closing process. It's very, very simple, and it's very consolidated. So that's an easy process. They do come with, some of them come with debt, which is a nice option. So I'm going to give you an example. If there's a building for $20 million and the sponsor wants to raise $10 million in investors, and then $10 million, they're going to go out and access a loan. They're going to get a loan. So the loan is made to the sponsor. So now they have the $20 million, the $10 million in investor money, equity, and the $10 million of loan. They are going to assign debt to each of those investors. So when you do a 1031 exchange, the two things you have to remember, you have to buy equal or greater in value, and you have to use all of your equity. So if you sell for $1 million and you have $400,000 worth of debt, you're only walking away with $600,000 in cash. However, you have to buy equal or greater. You have to buy $1 million worth of property. You can take your $600,000 invested in a DST that has 40% leverage, which has 40% debt. They're going to assign that $400,000 worth of non-recourse debt to you. And now you've exchanged for $1 million. you have $40 million on paper, $400,000 on paper, and then the $600,000 in cash you've invested. Again, non-recourse debt. You're not going out and getting a loan. The sponsor's doing all of that. They're building that into the rate that they pay you on a monthly basis. The monthly dividend or payment is typically around 5% annual yield. 4.5%, 5%, that's kind of where they land. The cash deals may be more, the ones with debt may be a little bit less. So loan carve-outs to apply to sponsors, not investments. The lenders don't underwrite the investors, so you're not applying for a loan. The sponsor makes all the decisions about the property for the investors. And that's one of the downfalls. So the biggest downfall with the DST is that it's not liquid. You're going to put your money in, and it can take 2 years, it can take 5 years, it can take 10 years before the sponsor decides to sell. The goal of the sponsor is to buy these properties low and to sell them high, to make their investors money, and then to sell them high. If the market turns around and tanks in a year after they purchase, well, they're not going to sell it. They're not going to sell it as a loss. So they're going to wait and they're going to hold on to it. So if you need the money, this is not the investment for you. This is not the good vehicle for you. What's nice about them? They're always available. There's hundreds of sponsors. There's thousands of deals that are out there every day that can be invested in. And these are the considerations. Why would you consider a DST? You can own property that you wouldn't normally own. Now all of a sudden you own a piece of a Amazon distribution center. So it gets you into this asset class or this quality of real estate that you wouldn't normally have. It allows you to diversify. So now you can buy multiple properties within one DST, or you can buy multiple DSTs. So you can really diversify, which is great. You can diversify regions and asset classes in different types of properties. It is a turnkey solution. So the sponsors literally do all the work for you. I have one. I used it as part of my exchange in 2020, and they told me 5%. It's been 5%, and then they just gave me an increase of another 1.5%. So now I'm up to like 6.5% right now as of yesterday. So I'm not as of yesterday, as of last month, but yeah, I like it, and I think it's a good solution for some people. Like I said, fast and easy closing, elimination of property management. Yeah, so now this becomes mailbox money. If you're done with being a landlord, you don't want the tenants, the toils, and the trash, this is a turnkey solution that you don't have to ever worry about. That's right, Dave, you cannot get out of the DST until the sponsor decides to sell. So again, could be 3 years, 5 years, 10 years. It doesn't really, you don't really know. But it gives you a good monthly income. And once the sponsor decides to sell, you're going to be in the same position. You can turn around and do another DST, do another exchange, cash out at that point and pay your taxes. You really can do anything you want from there. So I'm going to move on from DSTs, and I'm going to just talk quickly about triple net lease properties. A lot of people that are in residential properties have appreciated in value so much and now have a $2 million or $3 million triple decker in Somerville. They can start getting into commercial properties, and commercial properties tend to have a lot less of the tenants, toils, and trash, a lot less of that maintenance. So a triple net lease property is a property where there's a single tenant that pays 100% of everything. The expenses, including the insurance, the maintenance, the taxes. So you got one tenant kind of handling everything. Oftentimes they're those commercial properties like the AutoZones or the Dollar Trees or the Dunkin' Donuts or something like that. You buy that building and then you have that one tenant that handles all of it. Triple net leases are considered to be some of the most secure investment opportunities. There's predictable income over time. So you know exactly what you're getting every month, and it's predictable and it's baked into that lease. The only drawback is that it is a long-term lease. So going up, increasing the rent is a little bit harder. Increasing that is, so there may be a limited earnings potential with the triple net lease, but it's kind of guaranteed. So especially if you're backed by some of these big franchises or big companies like the CVS's and the Dollar Trees and the Dunkin' Donuts and things like that. So I just blew through so much information. That was 45 minutes on the dot from when I started of properties and parties that are involved with the 1031 exchange. So as I said, we act as qualified intermediary, and not all qualified intermediaries are created equally. So when you go out and you're shopping for a qualified intermediary, to help you facilitate your exchange, it is important to understand how they operate and making sure that they are in fact a reputable firm. So ask about, obviously we want your business. We want to act as your qualified intermediary. We want your referrals to your clients. We appreciate them and we treat them really well. We educate all of our clients and we make sure that the exchanges are structured and documented properly. But if you are shopping, the safety, these are the questions that you ask. How does the QI handle the funds, and what their fund management policy is, the strength of their financial partners and the banks that they use. What are the requirements to deposit or withdraw funds? Withdraw funds primarily. Is it under dual control? Do they have fraud protection in place? Wire, I'm sure if anybody's an attorney or a realtor or works for a title company, wire fraud is rampant. So what is the fraud protection that they have in place? Are they audited by a third party like we are every year? That's something that you want to discuss and make sure that that they are members of the Federation of Exchange Accommodators. The FEA is a trade organization. It's the only trade organization for qualified intermediaries. It's a very small industry. So go on their website at 1031.org and investigate who your qualified intermediary is. Again, we'd like it to be us. But this is my information along with Joe's information. Joe's going to be sending those this recording out. So when you click on him, he's going to get, when you click on anything, he's going to get the information. And Mike, I'm going to answer that question in one moment on reverse exchanges. So if anybody has any questions, again, feel free to unmute. I'm going to hang on for a little while. Feel free to unmute and ask me a question. You can type it in the chat and I'm going to go through those. Mike is asking about reverse exchanges. So who is getting the proceeds from the sale on the reverse exchange? So when a reverse exchange happens, what you're doing is you're purchasing the relinquished property first. So you're taking, however you can purchase that, you're purchasing the relinquished property first. And then you have 180 days to sell the, sorry, I said that wrong. You're purchasing the replacement property first. You're 180 days to sell the relinquished property. The day the relinquished property sells, the proceeds come to us really, really quickly, just so they filter through the exchange account, and then they go back to the investor to reimburse them for the purchase of the replacement property. So the proceeds come to us, but it's just a quick turnaround, just so they, from an accounting standpoint, they filter through, exchange, they go back to you, and you can pay yourself back. So we don't sit on reverse exchange funds for very long at all. Any other questions that people may have on DSTs, triple net lease, tenants in common? So the fees for this service. So our fee for a forward exchange, where you're selling one property and buying one property, is $1,950. That's where it starts. Once we get into more expensive properties, typically over $5 million, the fees go up. There's substantially more work on higher priced properties. If they are, and that's for one entity. So if there is one property and 3 tenants in common and they're all exchanging, those are all considered separate exchanges. So it would be $19.50 per person. And then that's for selling one property and buying one property. If you purchase multiple replacement properties, it's $500 each for each transaction. And then the improvements and the reverses start at about $8,900, just shy of $9,000. So those are our fees. We collect those at the time you sell your relinquished property. So that gets listed on the settlement statement, just like the realtor fees and the attorney fees and the settlement fees. Our fee gets listed and gets paid upon the sale. Any other questions I can answer? Trusts, single member disregarded entities, DSTs, tenants in common. Anything else? Nope. Going once, going twice. Okay, so I'm giving you 6 minutes back of your day. We're gonna log off at 12:54. So I'll give you 6 more minutes back, and I hope you have a wonderful day. If you have any questions, feel free to give me a call. Drop me an email if you want a copy of the PowerPoint. I'm happy to send that out. Otherwise, you'll be getting the recording in probably by the end of the day. Thank you so much for joining.